Welcome to The Explainer. Today we're going to do something a little bit different. We are stepping entirely away from the daily noise, the frantic price action, and the fleeting market sentiment. Instead, we're going to look at PLAZM purely through the eyes of a protocol designer. You see, when you build a system like this, you aren't focused on what a token chart does today, or tomorrow for that matter. You're focused on the structural architecture. You're focused on whether the core engine is truly anti-fragile. So let's put on our builder hats for a moment and walk through exactly why the system was designed the way it was.
Before we get into the actual mechanics, I need to give a quick, mandatory disclaimer. This explainer is strictly for educational and informational purposes. It is not financial advice, investment guidance, or a solicitation to buy or sell any digital asset. Cryptocurrency markets are highly volatile, and you can lose your entire investment. Always do your own research, consult a licensed financial advisor, and never interact with smart contracts using funds you cannot afford to lose.
Okay, let's dive into this. Most people who look at a protocol for the very first time, well, they look straight at the price. But as a systems architect, I can tell you that is exactly the wrong place to start. The right place to start is right here, with this single number, 13,592. That's the total number of PLAZM bonds outstanding on day 226 of the protocol. 6 months ago, it was a tiny fraction of that. Now, why should you care about this number? Because while the overall market regime swung wildly from extreme fear to greed and then right back to fear again, this number only ever moved in one direction, up. The market regime changed. The bond count did not. It just kept accreting. And that is not luck. That is a highly specific, very deliberate design choice.
To truly understand why that number only goes up, we have to change our paradigm entirely. We have to completely separate the speculative layer from the productive layer. Think of it like this. On one side, you have what most people obsess over: price charts, daily sentiment, volatility. That is the speculative layer. It's loud, it's noisy, and it's wildly unpredictable. But on the other side, you have the builder's domain, the productive layer. This is where you find the wiring diagrams, the mechanical cash flows, the immutable logic. The fatal flaw of the short-term view is conflating these two completely different things. A good designer builds a productive layer that is perfectly separated from the speculative layer. The chart can do whatever it wants. The wiring diagram, it just executes. And that means the core engine is entirely decoupled from the noise.
This brings us to a rather fundamental redefinition. You kind of have to forget everything traditional finance taught you about liabilities. Here, a bond is absolutely not a debt instrument. It's actually the exact inverse. It's a tokenized claim on a continuous stream of yield. When you acquire a bond in this system, you aren't lending the protocol money that it owes you back later. No, you are purchasing a permanent seat at the table of the protocol's cash flow generating engine.
Let's walk through the actual internal gears of that engine, step by step. First, when a bond is purchased, ETH enters the protocol's vault. But it doesn't just sit there gathering dust. Second, that capital is immediately deployed into active DEX-5 positions, participating directly in the E-share yield environment. This utilizes specific margin strategies to optimize returns, entirely avoiding traditional leverage. Third, those positions earn real yield, and that yield streams right back. A portion goes directly to you, the bondholder, and the rest flows back as a contribution into the protocol's core engine. You know the most elegant part of this flow? Once it's initiated, it requires absolutely zero external buyers to maintain itself.
And this brilliantly illustrates how the mechanics translate into hard numbers for day 226. A bond clears at a price of roughly $36.16, which is exactly 0.0159 ETH. The implied annual percentage yield on that bond is currently sitting at 31.6%, and the external buyers required to generate that yield? Zero. The bond is funded by pure mechanical productivity, happening completely regardless of whether the native token's spot price is pumping or dumping.
Now, this isn't just some neat little feature, it's a direct response to history. If we look back at the last few years, a ton of so-called real yield protocols quietly collapsed. Why? Well, because of fragile architecture. They paid their yield out in their own native token, so when the token price dropped, the yield dropped. People left, the token dropped further, and the whole system death spiraled down to zero. The builder of PLAZM looked at that graveyard of past protocols and designed a load-bearing structure specifically to prevent it. In PLAZM's architecture, the yield is sourced strictly from ETH. ETH lives completely outside this ecosystem and honestly couldn't care less about PLAZM's daily chart. By decoupling the yield source from the spot token, you sever that fatal downward spiral completely.
Now, what's really interesting here is a self-sustaining side loop known as buy and grow. This is the hidden engine that most outside observers completely miss when they try to evaluate the protocol's health. Let's look at the mechanical breakdown of that loop. The yield engine doesn't just pay out holders. Exactly 20% of the generated yield is automatically reinvested straight back into bond creation as a contribution. Think of it kind of like a continuous conveyor belt. The protocol is essentially acting as its own customer, automatically generating roughly 2.35 fresh bonds every single day without any marketing, without any hype. This happens purely mathematically. It doesn't rely on sentiment, and it hums along even if not a single new wallet enters the system.
Let's zoom out and see how this builds over, say, a 5-year horizon. We see a powerful dual-pressure system at work. If we hold the current design constant, assuming 0 new entrants, the bond count is structurally upward, expanding by a minimum of 850 bonds a year purely from that buy and grow loop. Simultaneously, the token supply is structurally downward, with 20% of the supply already permanently destroyed. All the while, the claimed profits counter, which is the cumulative yield deployed, is advancing by hundreds of dollars every single day. It's quite literally a machine that mechanically expands its own productivity while mechanically shrinking its own supply. But let's stay hyper-objective here. A true systems designer never claims a system is completely invincible. When we use the term anti-fragile in this context, it describes the system's behavior across different sentiment regimes. It is not a magical shield against all structural risk. A real engineer always looks for and openly acknowledges the exact breaking points of their design.
So what are the actual failure vectors? First, ETH DeFi yield. The engine relies on real-world inputs. If ETH-denominated yield or margin strategies in DeFi collapse to near 0, the engine slows down. Second, smart contracts. If there's a bug or an exploit that causes a leak, the engine could break catastrophically. Third, protocol governance. If governance decides to just modify the underlying rules of bond accrual, the design properties we've just been discussing could be fundamentally altered. If these core inputs fail, the system fails.
So the crucial point is this. We do not have to guess if the architecture is holding up, and we certainly don't have to trust anyone's marketing claims. Because the entire design is on-chain, it presents a falsifiable thesis. You don't need to trust me, you just need to trust the math on-chain. We have the exact metrics we need to test this engineering hypothesis in real time.
If you want to know if the protocol is structurally sound, ignore the daily price chart entirely and watch these 3 specific numbers. Number 1, bonds outstanding. This trend should point steadily up over weeks and months. Number 2, claimed profits cumulative, which currently sits at over $135,112.45. This curve should advance smoothly regardless of whatever the price regime is doing. Number 3, the daily yield deploy rate, currently clearing over $400 a day. If these 3 numbers continue to advance, the structural thesis is intact. But if they break, the design is in trouble. It really is that simple, and it's entirely verifiable.
And that wraps up our architectural walkthrough. As a final reminder, this explainer is strictly for educational purposes only. Smart contract risk, regulatory risk, and protocol design risk are all very real and material. Always conduct your own thorough research and consult a licensed financial advisor before making any decisions. But as you do step back into the market, ask yourself this: are you participating in a system that nervously relies on tomorrow's sentiment, or are you looking at a machine that is mechanically engineered to build itself? Thanks for joining me.